welcome to edX World and another video in the AS A-Level Accounting series. This video is going to be on business purchase, what accounting treatment have to be done when a business acquires another business. So we will deal with sole traders, partnerships and companies in this video. This video is going to be just on the basic examples so that it will just give you a start to this chapter. After understanding the basic concepts, you might have to go ahead and practice some difficult questions so that you'll be able to answer the questions that will be tested in the exam. So in this video, we are going to study the basic terms, the important terms when it comes to business purchase, the net assets acquired, the purchase consideration and the goodwill. And then we would see three examples. First one wherein two sole traders would merge into a partnership firm. Then a sole trader would merge with an existing partnership firm, and finally the merger of a sole trader or partnership firm with a company, with a limited liability company. So first understand the terms that I'm going to discuss with you. The first term is the net assets acquired. See, when a business is purchasing the other business, there is an agreement that the first company decides to acquire certain assets and liabilities of the target company. The first company might decide to acquire all the assets and liabilities, or it might decide to acquire only selected assets and liabilities of the company. So the net assets would be the total value of the assets that the company has agreed to acquire minus the total value of liabilities that the company has agreed to take over or acquire. Remember that when you're taking the value of assets and liabilities, it always has to be the current market value or the fair values of the assets and liabilities and not the book values, because the first company would compensate the target company for the market value of the assets and liabilities and not the book values or historical cost of assets and liabilities present in the existing financial statements of the target company. But in some questions, market values of all the assets and liabilities acquired are not given. In that case, we would assume that the market value is equal to the existing book values only, and we would take book values in calculating the net assets acquired. The second important term here is the purchase consideration. Purchase consideration is the amount that the first company or the acquiring company has agreed to pay or compensate the target company. Obviously, when it is acquiring net assets, it is getting assets. In return, the acquiring company will have to compensate the target company, and that is through the purchase consideration. Now, purchase consideration can be settled or discharged in multiple ways. The acquiring company may pay all cash to the target company, or it may decide to issue certain value of shares and pay the difference by cash or check, or it might also decide to discharge the purchase consideration by issue of shares, debentures, loans and cash. Multiple combinations are possible. We'll have to look at the information given in the question to see how the purchase consideration is discharged by the acquiring company. And finally, we have goodwill. Goodwill is the reputation or the good value of the target company, and acquiring company is compensating the target company for its good value or for its goodwill. Now, how is goodwill calculated? Now, I'll give you a very quick example here. Let's say the acquiring company is receiving net assets worth 100. A layman would compensate or would pay a purchase consideration of 100 to the target company. But at times, the acquiring company might decide to pay a higher amount over the net assets acquired, let's say 120 to the target company. Why? Because it feels that the business of target company has certain value of goodwill, and that goodwill will help the acquiring company to boost its profits or boost its business or help the business to expand in future. So the acquiring company decides to compensate the target company over and above the value of net assets acquired. That difference is the goodwill. So goodwill is equal to your purchase consideration paid minus the net assets acquired by the acquiring company. So we have an example here wherein two sole traders A and B decide to merge their business, form a new partnership firm AB. The balance sheet of the existing sole traders are given. We have some additional information. A and B would transfer all the assets and liabilities except the cash balance. They would not transfer that to the partnership firm. The market value of non-current assets are given, for A 96,000 and for B 130,000. Remember, to calculate our net assets acquired, we would take these market values of non-current assets and not the book values of 85,000 and 135,000. For all other assets and liabilities, since market values are not given, we will take their book values. And the capital balances of A and B in the new firm have to be 150,000 each. Any shortfall will have to be contributed by them in cash. So first let us try to calculate the net assets that are transferred by these sole traders to the new firm, because the value of the net assets will help us gain an idea what will be the capital balance of these sole traders in the new firm. So if I have to calculate the value of net assets of the sole trader A, I would take a total of the non-current assets plus current assets and deduct the trade payables or the current liabilities, because all assets and liabilities are taken over except cash. So I'm not going to consider cash, rest all the assets and liabilities will be considered here. So for non-current assets, we will take the market value of 96,000 plus inventory of 8,000 plus trade receivables of 6,000 minus trade payables of 3,000. Liabilities are always deducted to arrive at the net assets. So if you take a total here, we would get 107,000. So this is the value of net assets contributed by A to the new firm AB. Now, as per adjustment number 3, they want that each of the partners should have a capital balance of 150,000 in the firm, but the value of assets contributed by A in the firm would just be 107,000. So the cash contribution by A will have to be the difference between the capital required, which is 150,000, minus the value of net assets contributed 107,000. So 43,000 will be compensated or contributed by A in cash in the new firm AB. In the same way, we would also calculate the net assets of B. The value of net assets of B would be non-current assets 130,000 plus inventory of 12,000 plus trade receivables of 9,000 and minus 11,000 for trade payables. So 140,000. Again, capital of B has to be 150,000 in the new firm. So cash contributed by B will be the difference 150 minus 140, 10,000. So 10,000 would be contributed by B in cash and 43,000 would be contributed by A in cash. So after analyzing all this, our next step is to prepare the balance sheet of the new firm AB after the sole traders have merged their businesses. So let's prepare the balance sheet. Non-current assets of AB, the new firm, would be the total of non-current assets contributed by A and B, which is 96,000 plus 130,000. So A contributed 96,000. Remember one thing, I'm not taking the book values of the assets of A and B, I'm taking the market values. 96,000 plus 130,000 would be 226,000 value of non-current assets. Inventory contributed by A and B 8,000 plus 12,000, no market values are given, so we take book values in this case 20,000. Trade receivables of A and B 6,000 plus 9,000, 15,000. And cash contributed by A and B, A contributed 43,000 and B contributed 10,000. So total cash in the new firm would be 53,000. Remember one thing, I'm not taking the cash balances of the sole traders businesses, which is 4,000 and 5,000, because the new firm has not taken over the cash balances. Cash balances would remain with the sole traders only. Now let's take a total of the non-current assets and the current assets to get the total assets of the new balance sheet. If we take a total, we would get 314,000. Okay, let's finish the other part of the balance sheet. Capital of A and B, it was agreed that they want a capital of 150,000 each, and that's why they made the difference contribution in cash. So capital would be straight 150,000 each. Trade payables contributed by A and B 3,000 plus 11,000 from their old balance sheet, 14,000. Again, if you take a total of the capital and liabilities, you will get 314,000. So this completes the balance sheet of the new firm. Again, I've taken a very simple example with very limited adjustments. Try practicing more questions on these and see if you can now solve them. I've given you a base to start with. I've given you a basic understanding of how to go ahead. Now try solving more questions on your own. Okay, next we have a merger of sole trader and a company. Okay, in this, the sole trader A is given XYZ PLC, which is a limited company, acquired the business of A, and the balance sheet of both businesses are given. We have certain adjustments. XYZ PLC would take over all assets except the cash and bank of A. So all other assets and liabilities would be taken. Market value of non-current assets is given as 96,000. Again, this would be considered instead of book value. For all other assets and liabilities, market values are not there, so book values will be taken. Purchase consideration was decided at 120,000. XYZ decided to pay A 120,000, and it was discharged partly by shares and remaining through check or through the bank account. Let us do some analysis. Find out the net assets taken over. Find out purchase consideration is already given. Find out the goodwill value, and then we'll go ahead and prepare the balance sheet of XYZ. So if I have to calculate the net assets of A, which are acquired by XYZ PLC, I'll start with the non-current assets of 96,000, the market value, plus inventory of 8,000, trade receivables of 6,000, 4,000 I'm not taking because XYZ has not taken over cash balances, and I have minus 3,000 for liabilities. So the net assets taken over here would be 107,000. The purchase consideration paid by XYZ PLC is directly given in this question, which is 120,000. So understand that if XYZ PLC is gaining net assets worth 107,000, why is it paying the sole trader A 120,000? It is paying $13,000 extra. Why? Because there is a certain goodwill value attached to the business of sole trader A, and when XYZ acquires that business, the benefits attached with that goodwill will now be gained by XYZ. So XYZ is paying $13,000 extra, and hence the goodwill value would be your purchase consideration 120,000 minus net assets acquired 107,000, so $13,000. It is also important to understand the discharge of purchase consideration, because that will help us in preparing the balance sheet of XYZ. So purchase consideration is 120,000 given directly. It says discharged by issuing 100,000 shares at a premium of 0.05. If you see the balance sheet, ordinary share capital is $1 per share. It means the face value or the nominal value of the shares is $1. So 100,000 shares are issued, but not at face value, at a premium of 0.05. It means the issue price of the shares is 1.05. The face value plus the premium value, if we multiply that by the number of shares issued, we would get 105,000, which is the total current value of the shares that have been issued by XYZ to A. And it says the balance amount was paid by bank, paid through the bank account. So 120,000 minus 105,000, 15,000 was discharged through the business bank account. This will be helpful when we prepare our balance sheet of the XYZ PLC after the merger. Let's go ahead and prepare the balance sheet. So we have our balance sheet format here. Remember, whenever there is goodwill, goodwill is an intangible asset. It will always be shown on the top, on the first, in the non-current assets section. In our question, we've already calculated goodwill, purchase consideration minus the net assets acquired, 13,000. Then we have the non-current assets tangibles. The existing non-current assets of XYZ PLC before the merger was 426,000. It acquired non-current assets of sole trader A, which was valued at 96,000 as of the date of merger. So the total non-current assets would be here 522,000. Inventory, existing inventory of XYZ PLC was 94,000, and inventory acquired of A 8,000, so 102,000. Again, trade receivables of XYZ PLC before the merger 68,000 plus trade receivables of A is 6,000, so 74,000. Cash balances of A are not acquired, obviously, given in the question. Existing cash balances of XYZ PLC was 36,000 in the previous balance sheet, but out of this 15,000 has been utilized to pay sole trader A. So the difference or the remaining cash balance or the bank balance remaining is 21,000. Let's take a total of all our assets, the non-current assets and the current assets. So we have a total asset value of 732,000 of XYZ PLC after the merger. Let's go on to the next part, which is the equity parts and the liability part. So equity starts with the ordinary share capital. See, the existing ordinary share capital of XYZ PLC was 500,000 before the merger, and XYZ PLC issued 100,000 new shares to A. The point is, XYZ issued these shares at premium, so the total value of the shares was 105,000. Now, question is, should I add 100,000 here, only the face value, or should I add the premium also here, including the 5,000? The answer is you should only add the face value when you're recording the value of ordinary share capital. So the face value of the shares were 100,000. So 500,000 plus 100,000, total ordinary share capital after merger 600,000. Share premium will be recorded separately, 5,000. There is no existing share premium of XYZ PLC, so the only value in share premium would be the premium of the shares issued to sole trader A. Reserves of the existing balance sheet, 55,000, remains same. Current liabilities, trade payables of the existing balance sheet before the merger was 69,000 plus 3,000 contributed by, or 3,000 acquired of sole trader A, 72,000. Let's take a total of the equity and liabilities of XYZ PLC. So we have a total of 732,000 for the other side also. Our balance sheet is matched, and this is how you complete the balance sheet of the company after the company takes over or merges with a sole trader. And finally, we have the merger of a company with an existing partnership business. So XYZ PLC acquired the business of AB and the balance sheets are given. The only difference between the previous question and this question is that I have added the 8% loan from a partner in the balance sheet of the firm. Otherwise, the way we've prepared our balance sheet in the previous question, the format would remain same, the sequence would remain the same. Information is given, XYZ PLC would take over all assets of the firm except cash and bank balances. Purchase consideration, total purchase consideration is not given in this question. So first we will also have to calculate purchase consideration. In the previous question, it was directly given as 120,000. But the total discharge of purchase consideration is given. It is discharged by issuing 200,000 shares at a premium of 0.1. Face value is 1, premium is 0.1. So the total value of shares is 200,000 into 1.1. Apart from shares, the company will also issue certain 10% debentures to A. The value is not given, we'll have to calculate. We will see just in a bit. And 12,000 will be paid by check. So when we take the total discharge of purchase consideration by each of these methods, we add it, we will arrive at the total purchase consideration. We will deduct the value of net assets from the purchase consideration and calculate goodwill. Then only we can go ahead and prepare the balance sheet. Let's find out the total purchase consideration first. Now, purchase consideration is made up of three parts. First, issue of shares. Now, shares are issued, 200,000 shares are issued, number of shares 200,000, multiplied by face value of 1 and premium of 0.1. So the total value of shares would be 200,000 into 1.1, 220,000. So this is our first part of the discharge of purchase consideration. Second, certain value of 10% debentures are issued to A. We'll have to calculate that value. The condition is that the value of debentures should be such that A continues to receive the same amount of interest based on 10% rate that he was receiving from the partnership firm. The partnership firm was paying an interest of 8% of 50,000 to A, which if you calculate comes to 4,000. This interest, if it has to be maintained with the debentures carrying an interest rate of 10%, what would be the value of the debentures that will have to be issued? We will arrive at 40,000. So the formula is calculate the value of the interest that the partner was receiving and divide it by the rate of interest of the new debentures to arrive at the value of the debentures that will have to be issued. This is part number 2 of the purchase consideration, and third part is obviously given, paid by bank directly, 12,000. So if we add up these three parts of the discharge of purchase consideration, we will arrive at the total purchase consideration of 272,000. Next, we need to calculate the value of net assets acquired by XYZ PLC. We will have to take the total of assets, deduct the liabilities. When taking the total of assets, the market value of assets are not given, so we will assume here that the book values are only considered. So non-current assets of 226,000 plus inventory of 20,000 plus 15,000 receivables. Cash and bank balances are not acquired, minus 14,000 for trade payables. So 247,000 will be the value of net assets acquired. Now goodwill value will be the purchase consideration minus the net assets acquired. 272 minus 247, 25,000 is the value of goodwill. Let's continue and prepare the balance sheet of XYZ PLC. Again, intangibles, we've already calculated the value of goodwill as 25,000. Tangibles, existing assets of the XYZ PLC is 426,000 plus non-current assets of the firm is 226,000. So the total here would be 652,000 total tangible non-current asset. Moving to our current assets, inventory, existing inventory of the company is 94,000. Inventory acquired of AB is 20,000, so 114,000. Receivables of XYZ PLC before the merger 68,000. Acquired of AB is 15,000, 83,000. And cash and bank balance of the XYZ PLC before the merger is 36,000. 12,000 is paid by check to the firm AB. So the remaining cash balance or bank balance remains in the firm is 24,000. Let's take a total of the assets. So we arrive at 898,000 total value of assets. Let's go ahead and prepare the ordinary share capital similar to what we've seen in the sole trader. Now existing share capital of the company was 500,000. They've issued 200,000 fresh shares to firm AB. So the total value of ordinary share capital would be 700,000 because the face value is $1 per share. Share premium included in the purchase consideration was 20,000. If you remember, 0.1 into 200,000 number of shares, you will get 20,000. Existing, there is no share premium, so only the new share premium would be recorded. Reserves of the company before the merger were 55,000. 10% debentures we have already calculated as 40,000, and the current liabilities existing before the merger was 69 plus 14,000 of the firm AB, so 83,000 trade payables or current liabilities. Let us take a total of the equity and liabilities. Again, we arrive at 898,000 total equity and liabilities. Our balance sheet has matched, and this is how you complete your balance sheet of the company after it has acquired the partnership firm. Apart from this, you may also see questions when you're supposed to close the books of the partnership firm by preparing a realization account, capital account and bank account. Now, the dissolution of the firm or the closure of a partnership firm has already been discussed in detail in my dissolution video, the link of which I'll be putting in the description box. If you've not watched that video or you're not clear with the dissolution process, with the entries to be passed at the time of dissolution, please watch that video first before continuing here, because this video will make more sense only after you watch that video or only after you know about the entries to be passed at the time of dissolution of the partnership firm. So as you know, at the time of dissolution of a partnership firm, we prepare a realization account to close all the assets and liabilities, realize the value and can be used to pay the liabilities of the firm, and the balance will be distributed between the partners. So when preparing the realization account, first step is to transfer the value of all the assets on the debit and liabilities on the credit at their book values. So I'll be doing that first. So I have my non-current assets first. Non-current assets of the firm AB given 226,000 book value, and we will also transfer the inventory 20,000. Debtors or trade receivables will be transferred, which is 15,000. Remember, cash and bank balances are never transferred to the realization account. You transfer all the assets except cash and bank. Keep that in mind. And on the credit side, I'll transfer my liabilities. Again, when transferring the liabilities, do not transfer partner's loan or liability of the firm towards the partner. Just transfer the external liabilities, which in this case is trade payables, at 14,000. Now, if you remember my video on dissolution, or if you've already seen that video, what we do next is on the credit side, we record the amounts received from sale of assets, and then on the debit side, we record the amount that is paid towards to settle the liabilities of the firm. But in this case, the company is not selling the assets individually, or it's not discharging its liabilities individually. What is happening is the company is receiving a single purchase consideration from the company XYZ PLC, and hence we would directly record that purchase consideration here in the realization account. So on the credit side, XYZ PLC, in bracket, you can say that purchase consideration. This is the net amount receivable by the firm for sale of all its assets and liabilities, and the purchase consideration was 272,000. No other information given about realization cost or anything else. So let's close our realization account, find out the profit on realization, which will be eventually transferred to the partner's capital. So taking a total on the credit side, 286,000. And profit on realization will be transferred to the two partners A and B. Profit sharing ratio is not given. We will assume it is equal. But before that, let us calculate the profit. 286,000. If we deduct all the values on the debit from 286,000, we will get a profit on realization of 25,000. So 25,000 will be divided equally between the two partners. So 12,500 each. Once the realization account is done, we also need to prepare our capital accounts of the partners. So we have a columnar capital account here. Capital account would obviously begin with balances brought down from the balance sheet, which is 150,000. 150,000. Then let's transfer the realization profit of 12,500, 12,500. If you remember from my dissolution video, the partner's loan is directly settled from the business bank account. But in this case, we are not paying the partner, we are not discharging partner's loan through money. What we are doing is we are giving the 10% debentures of XYZ PLC to the partner A in discharge of the loan, in discharge of the liability. So what we'll do is we'll first transfer the partner's loan in this account, and then we'll also record the discharge of that loan through the capital account. So partner's loan would be transferred here, 8% loan from A, in A's column 50,000. And against this loan, the firm is going to give away 10% debentures of XYZ PLC to A. It is first going to receive the 10% debentures from XYZ PLC, and then the firm will distribute it to A in discharge of the loan amount. So 10% debentures of XYZ PLC. If you remember, we received 40,000 worth of debentures that will be given entirely to A. Then the firm also received shares worth 220,000 from XYZ PLC that will also be distributed between the partners. Normally in the question, they mention that the shares would be distributed in a certain ratio, let's say ratio of capital or a certain agreed ratio. In this example, nothing is given, no agreed ratio is given, so we will assume that they are distributing it equally. But if the ratio is given, please distribute the shares in that ratio. So ordinary shares of XYZ PLC, 220,000 divided equally between the two partners, 110,000 each. Now the difference in the capital accounts will be settled by business bank account, by the firm's bank account. So taking a total on the credit side, 212,500 for A, And when we deduct the entries on the debit side from 212,000, difference would be 62,500. And same for B, we would take a total on the credit side of 162,500. When we deduct 110,000 from 62,500, we get 52,500. So 62,500 and 52,500 will be paid to A and B through the firm's bank account. Next step is to prepare a bank account, which I'm not going to do here. It's very simple. Opening balance of the firm's bank account given is 103,000. On the debit side, balance is brought down. Plus, the firm also receives 12,000 as money from XYZ PLC. So total money available will be 115,000 to the firm. Now this 150,000 is paid 62,500 to A and 52,500 to B. No complications in preparing the bank account. I'm sure you can do it on your own. I hope this video was useful. This was just a basic understanding about business purchase. You will definitely have to practice more to get a better understanding, to be more confident in exam. If you enjoyed the video, please like the video. Please share the video with your friends. Do not forget to subscribe to the channel and press the bell icon. I'll see you soon with a new video.